I have a very special guest today, someone that is huge in the personal finance community. He's the co-host of Stacking Benjamins, which is the only podcast that the personal finance community's Plutus Awards has retired from the competition after winning the coveted Best Podcast Award twice. If you're a fan of the Stacking Benjamins podcast, you know him as OG, which stands for The Other Guy. But I'm so lucky to know OG as Josh Bannerman, the acclaimed financial advisor and certified financial planner. One of the things I love about OG on his show is he takes that role of being an insider and speaks freely about behind the scenes. So he frankly shares these thoughts on the state of the financial planning industry. And really, he's always thinking about guiding listeners towards better money solutions. Josh, I'm going to make sure to link your firm and your show in the show notes, but thank you so much for joining me today.
Yeah, thanks for finally inviting me to your show.
I got you in the first half dozen or so guests. You're a very busy man. And again, your show is
actually,
enormous.
I'm not busy at all.
Hoping, well, I'm trying to make you look good on the show for you guys. Josh, I know him personally enough, and he knows me personally enough that we know all the real behind the scenes looks. But Josh, just for my own audience, for those who haven't heard of your show, could you give them a little background about the show itself, how it started, and sort of where you are today?
So Joe and I started Stacking Benjamins 10 years ago this month, as a matter of fact. So we just had our 10-year anniversary, which is very weird to think about because I don't remember not doing the show. But it also seems like it's been way longer than that. So it's like only 10. I thought I was making progress.
You guys getting each other gifts?
My gift to him was showing up for the recording session again this week. So, but Joe and I have known each other a quarter century. He worked at American Express back when I did, and was kind of the go-to media person. You know, if somebody was going to be on the news or somebody was going to be quoted in the newspaper, it was always Joe. And he's, I like to say, substantially older than I am. He doesn't like that terminology, but he's older than I am, but we got along really well. And his wife took a job in Texarkana several years ago, and they moved. And he sold his practice, and we just kind of kept talking. We had done some radio work together in Michigan, mostly because I lived the closest to the radio station. But I've always been on stage my entire life. You know, just by other personal stuff. I was always in acting and, you know, that sort of thing. So it's easy for me to be in front of everybody, even if it's just, you know, audio. So we just kept in touch. We started a blog. It sucked. It's still in existence. We sold it. It is funny getting emails from the people because I'm still on the email list. So I get emails of like, hey, we wrote this article. It's like, actually, I wrote that article in 2009, but okay. But we would spend hours talking to each other on the phone about all the stuff we were going to write about. And somebody said to the other person, I don't know who said it first, we ought to record these conversations. And so that turned into the podcast. We had a 13-show run where thankfully nobody listened to. It just trying to kind of work as many kinks out as we could. And then we did another 42 episodes of a show called Two Guys and Your Money. And then we kind of rebranded to Stacking Benjamins. And so now we do 3 shows a week. We go 8 weeks on, 1 week off. And we've been doing it for 10 years. So 1,100 some odd shows. The whole idea of Stacking Benjamins is really kind of centered around the idea that talking about money, for whatever reason, is so it's so poo-poo, right? It's just so like, I don't want to talk about money. You tell a stranger at the grocery or the gas station, you know, hey, I've got this mole here, and they're going to take it out, and it's, you know, you would tell this random person that, but you would never talk about like, hey, I'm in credit card debt. Like, what do I do about that? Or I have no idea what funds to pick in my 401k. You would never ask a stranger. You don't even ask people you care about. And so what we wanted to do was try to take the topic of money and make it funny. It's full of dad jokes. It's very campy. It's a very magazine style. So if, you know, 10 minutes in, this doesn't apply to me, just wait 10 minutes. There'll be something else, you know, and we change stuff pretty frequently, you know, kind of throughout the show. So we've tried to do that. Apparently people are enjoying it. So that's good.
Well, and you guys were also early in the podcast realm where nowadays content creators, thought leaders like myself, if you're not hosting a podcast like this, then you're a little bit behind the curve. You were ahead of the curve, and you guys certainly have been a staple for a lot of people listening to personal finance and investing podcasts. The thing is, though, since then, eventually people said, well, hey, I want some advice with my money. And you ultimately started your own firm, correct?
So I've been a planner since '99. Had worked as an advisor and had my own thing that whole time. But the whole idea of the other guy component of it was, and all the marketing people in the universe right now are like going, wait, what? And Peter, you remember this conversation that you and I had with a mutual friend, Mary Beth, who just was like, she couldn't even comprehend what I'm about to say. But my idea was, if there's no attachment to our firm on the show, then it's more believable. I never wanted somebody to say, well, the reason he says that is because he sells that, or the reason he doesn't say that is because he doesn't sell that. And so my whole idea of the other guy was, well, let's just make it so that there's no connection whatsoever. And then, then there's no quote unquote incentive to say whatever. And I kind of took a cue from the, long time ago in Money Magazine. They had the, undercover CFP. In Golf Digest now, they have the undercover tour caddy or tour pro, who will write like little snippets of like things that you're like, wow, I didn't know that they did that. And so I thought it added a little bit of credibility, and maybe it did early on. But what happened for the first 5 years was we people would write to Joe and say, how do I get in touch with this fellow? Because kind of speaking my language, and every time Joe would ask me about it, I go, no, we're not going to do that. I don't want to do that. And all the marketing people are going, you're doing what? Stop. And you and Mary Beth and some of these other people that we know all said, you gotta think of it from a different perspective, which is, we're out there trying to help people, and we're doing it, in this scale. But there's other people who need other help, and how else can we do it? And so it was 5 years ago where we put it on the back end of the show. If you want to get in touch with OG, here's how you do it. And the first day we did that, 17 people scheduled meetings. And I was like, oh, okay. Yeah, there's probably lots of people that need other help. And now I'm so lucky I get to talk to people all day, every day about money. And I have a small team of other CFPs that work with me. And so a lot of the behind the scenes stuff happens, for our clients with them. And now I just get to do this stuff, which is kind of preach the good news and let people know that you don't have to have $1 trillion to retire. We'll figure it out.
Well, and objective advice is already hard enough to find. And you're right, it is admirable for you to have done it anonymously in the podcast format for such a long period of time. And all of us who are putting out regular financial education are hoping to be helpful. Yeah. I think that's usually the common goal, is you hope to be helpful. How you can be helpful, though, in a private setting versus speaking to, in your case, tens of thousands, hundreds of thousands of people at a time, that's a real different challenge. Just sort of like when somebody will ask me a question at a social setting, whether it's my kid's soccer game or out at dinner with other couples. And right. You wouldn't believe all of the, what do you think of this? Where's the market going? And you have to, and a lot of people stop and they start listening, and you give an answer that is by no means going to be tailored to their specific
radio answer.
Need. You have to give them a safe answer, a minimize regret, a minimize error type answer. But in your experience, because so many people find you through your show first before becoming clients, how do you feel like those relationships are different once you are working with somebody across the table or across the camera in the instance of Zoom meetings? I
have a couple of stories that I think are pretty interesting. None of this is stuff that I intentionally thought of or it just, and it didn't even hit me kind of in the moment. It was probably long after the fact. I had a call with somebody who had listened to the show for a while. And that's usually one of my first questions is, how long have you listened to the show? Because almost no one talks to me without having known the show first. On occasion, I have had it on occasion like, the show, what's the show? And I'm like, and I'm like, feverishly typing in my computer, like, how does this person oh, you came from Bill. Oh, yeah. So how long have you known Bill? I'm sorry, I said show. I meant how long have you met Bill? But But anyway, so this guy, he says, "Oh, I've listened to you guys for a long time," and he asked this question. We were talking, having a conversation, and he asked this question, and I answered it, and he says, "Oh my God, that's unbelievable." And I said, "I don't get usually that response when answering financial questions." He says, "No, almost literally word for word, you answered this exact same question like 4 years ago on the show as part of the Q&A section one time, and you almost use the exact same words." And I said, "That, well, it is what it is, right? The truth is the truth." So that's a good thing, It would be different if I was like, on one hand saying one thing and on the other is another. So, bonus points for congruency. But you identify one of the major issues with financial media in general, whether it's something as broad-based as, like the CNBCers of the world, or the Wall Street Journal, personal finance articles or something like that, or something much, much smaller like our podcast or your show and newsletter and stuff like that. You have to make the answer good enough that it's an 80% solution where you're like, this is the issue with just put all your money in an index fund and call it a day. Like, is that the best answer? Probably not. Is it a good enough answer for 90% of the population and gets them almost all the way there? Absolutely. And you and I know that the answer isn't even what fund you're going to pick. Like, who gives a crap? You can pick these selection of funds or that selection of funds or that selection of funds. It's the decision that you make when things don't go your way that's really going to be the determination. And how much money you're saving anyway. You can't solve for, well, I'll just try to get 12% instead of 8. It doesn't work that way. You have to put money into your savings plan. And so, I think the biggest answers that you have on the radio or on, your broad-based media type stuff have to be those 80% solutions. And when you have the opportunity to work with a client one-on-one, you get a much better quality of, personalized decision. It doesn't mean the outcomes are going to be any better, because you and I both know that you can't control outcomes either. But you kind of add that extra 80% of the 20% that's left over, where it's like, well, now we have a 96% solution. We're probably really good now. But that's part of the problem with these big questions. I had a show that we did a couple weeks ago where we were talking about buying a new car. And, I kind of brushed over some of the facts of the case, and basically it was, yeah, you should buy a new car. And the internet went ablaze. Oh, geez, I'm recommending that everybody should buy cars. It's like, okay, that's not what I said. I said that this guy could, like, well, it's not a good financial decision. I'm like, you don't know all the facts. Like, it is for him. He's 70 and he has a boatload of money in the bank and he has no heirs and he doesn't spend any of it. And buying a, $10,000 extra on a truck makes him happy. Let's do it, And so that's part of the, and I think we also have to be cognizant of that as we review other people's broad 80% answers on the internet as well. I know you've got a big Twitter presence and I don't, and I'm super jealous. So maybe I'll try to steal some of your Twitter followers, but
if I could give them to you, I would. I don't know how that works.
I actually posed this question the other day. How do you merge accounts? Like, is there a way?
We could trade accounts. You want to trade accounts with me for a week? This could be an on-show trade of accounts, and see if me tweeting from your account, it won't make any difference.
I don't mean that. Although I would end up worse for you than me, I think. But so be careful. I'm saying, like, we've got all these different. I've got like my personal Twitter and my personal Instagram, and what I mean. Like, how do I put this all into like one thing? I don't know. Maybe somebody knows how to do that. But we have to give each other a lot of grace, I think. So many times you read something in the newspaper or you hear something on a podcast, you're like, that's a terrible idea. It's like, okay, they're pros. It's probably not a terrible idea. They're trying to make it, an 80% answer.
Josh, I feel like because we have friends that listen to our shows, you're trying to walk me into the fact that I have a burner account with more followers than my normal
I was
account.
Not even going to bring that up. I didn't know that was...
I thought that's where you were walking to, and that's okay. There was something interesting about this sort of talking to the public versus private, where you give 80% of the answer. And anybody who knows anything about chess, which is not a big part of the population, knows that even chess masters, like, yes, they're smart, but mostly they recognize patterns. And so you and I have sat down with countless individuals and families, and we've seen lots of things. And so we know what the patterns are. And when you're giving advice, if I see half of the chessboard, I could probably, based on what I know, what I'm supposed to do with my chess pieces, I'm supposed to get my pieces to the middle, I'm supposed to get my pieces out on the board, I'm supposed to protect the king, I could probably make an intelligent piece of advice based on what I do see and just knowing best practices. And that's a lot of what we have to do. But things get pulled out of context. And I always tell people, when you're listening to thought leaders, or you're reading their content or watching them on TV or whatever, you have to remember who their audience is, because they're speaking to their audience. And you also have to understand their incentives, which, again, we point out that you for so long did this anonymously, and the fact that you have people who are coming to you saying, yeah, I heard you say that exact thing. Those core investment beliefs, those core financial planning beliefs, I'd actually love to dig into some of those with you, try to figure out what are some of those Josherisms that come out a lot from you.
TM.
So
Trademark.
Yes, we'll register that one later. When you think about investing, let's start there. And people come to you with, Josh, I'm worried about fill in the blank, crisis XYZ, issue XYZ, and I'm thinking about making this change to my portfolio. What is the type of thing that you're telling them in that situation?
Am I the only one that thinks in memes now? Like when you answer, you think in your head, like, how can I answer this in a meme? With all the short phrase communication that goes on, whether it's texting or DMs on Instagram or something like that, it just seems like the right answer is always exists in a meme. And so the meme that's in my brain right now, you probably already know, is the one from Michael Scott where he's screaming, "No, God, no, no, no." I can't even do it justice. But no, I think
we'll make sure to have the GIF in the show notes of that. Yeah, we'll get that.
Yeah,
that going.
Is it GIF or GIF? I don't. I'm too old to know the difference.
Well, we could have that debate, but we'll spare our listeners.
Thank you. Spare me too, also, as a matter of fact. The biggest determinant in long-term investor success is what they do when things don't go their way. I think a big myth that people have is, I just throw my money in this thing, and some days it's good and some days it's bad. But we have so much data to suggest that within a pretty high degree of certainty, or confidence, I think is probably a better word, we know what the right collection of things, or this collection of things, will do over a long period of time. Not with certainty, but with a high amount of confidence to say, if you just go into a coma and have this collection of stuff based on the last 100 years worth of data, we would expect this outcome. And what's interesting about financial planning and investment management is that every year we get new data that feeds into the model. So we have more stuff that then supports or can tweak our future decision making. So the biggest thing that I think people get in trouble with is making decisions on short-term or with short-term information with long-term money or long-term decisions. I mean, I think looking back over a long period of time provides a lot of context for how you can view different things, and whether that's something as simple as like zooming out of the, you look at the chart, your investment, you look at one day and it like may go down. You look at a week and it may go down. You look at a month or a year and it may go down. But if you look at like 30 years, it's going straight up. That kind of looking backwards instead of forward, I think, helps quite a bit in the context. A great exercise is, if you don't know what the Dow was or the S&P was when you were born, you should know what that number is. And it's mind-boggling when you think of where it is today, and whatever number it was when you were born, it's some crazy multiple of that. And then you go, well, I'm 40. Actually, I'm older than that, but I'm in my 40s. And in the 70s, the Dow was at 600, and now it's at 30,000 and some change. So I plan on living another 2 times what I've already lived. I'm going to live to be 140. It's a whole different topic, but at least I got 60 more years to go. So it sounds so crazy to assume that the market is going to go up to 300,000 or something like that in our lifetime. But what else could it do? What else, milk's done it. Why wouldn't the stock market? I mean,
as long as the CEOs of companies continue to like money and want to make profit, it's hard to imagine a scenario where stocks over long periods of time don't continue to rise. And to your point, inflation alone, prices, if all they did was have profits rise at the rate of inflation, that still means
so when people come in, they're like, well, what do you make of, the Congress is going to pass this new law that's going to ban such and such a thing, and that affects this subsector, the economy. It's like, well, all those really smart people who love the fact that they get paid in stock options and are gazillionaires aren't going to go, we're good. Let's just mail it in. No, they're going to go, all right, we can't do this. Looks like we're doing this. And it's going to take them a few periods of time, a year to solve it, and then be like, a great example is COVID and Disney, right? Disney's like, what do we make our money? Selling hot dogs and $100 tickets to go see Magic Kingdom, right? You can't do that anymore. Did they go oh, well, we're out. Too bad. It was a good run, guys. Pack it up. Dismantle the stuff. No, they said, you know what we should do? We should launch Hamilton. Like, but the nobody will see Hamilton in the theater. No one's going to see Lin-Manuel Miranda do Hamilton anyway. So what does it matter? So put that on the internet, and we'll charge everybody $15 a year. What a bargain! Or $15 a month, or whatever the hell it is. And they made, how much money did they make? $1 billion or something, instantaneously. Yeah,
right out the gate.
Fastest growing streaming network. Now, there's some downsides to that. Now it's starting to trend down. They've got to create content and all this other sort of stuff to kind of keep people interested. But my point is, the smartest people in the world run organizations. And as long as people are still okay with making money and frankly encouraged to do more and more of that. Isn't that what we do? We're trying to make more money so that we can retire someday or something. As long as that's the goal, smart money will always flow to the areas of the economy that are producing that outcome. So, so you don't have to think short term, and you don't have to do anything silly. You're trying to prevent the big mistake. I'll give you an example of this as well. My brother worked at a bank, and for those who are aware of the Stacking Benjamin show, this is Steak Brother, which is a whole different story if you don't know that one. But this is my little brother. He worked at a bank as for lack of a better term, like an associate planner. How banks have the financial planning arm, which is a whole different thing we could get into. But he worked there, and we talk all the time. In a similar industry, we're brothers. We spend a lot of time on the phone, and COVID happens, and he's asking me, "Hey, what are you guys doing?" I'm like, "What are we doing?" Holding hands and dumping money in. What are you doing? And we got bank customers that are a little more concerned, and so we're talking about that. On March 23rd, he called and he said, "We took at the close all $650 million of the assets that we manage all to cash." Because the manager assumed, the guy who's in charge predicted that this is going to continue beyond that. And in my soul, on that moment, I knew that was the bottom. Because that was, if you look, was the day that the market was down 11% or something. It was, it was the last day. And then the next day, the stock market went up 10. So it was down 11 plus 10 back-to-back days. They were out on the minus 11, up on the, or they got out. They took the minus 11, did not get the plus 10. And that day I called my brother and I said, you should probably change jobs. Because once people figure out that they took the minus 60 million, but didn't get the plus 56 million on the backside, there's going to be lots of problems. You're trying to avoid that big mistake. And that mistake happened with a professional. Right, it's not in the camera. There we go. Professional. I have to use air quotes. So
Well, and it compounds forever. So once you've made that mistake, you got to make it up requires an enormous reversal that probably isn't going to happen.
I mean, you've been doing this a long time. I've been doing this a long time. I know of people that in the mid 20 teens were waiting for the market to recover from the recession. Like, what? Recover from what? It was at, right. The S&P was at 600. It's at 2,000. What are you waiting on? The other thing that I find very comical, and it's a little sadistic. Do you ever get the people? Do you ever talk to people who say, "I'm just waiting for the next correction and then I'm going to invest"?
Yeah, of course. Okay. Yes.
So, did you call them or email them at the end of last month and be like, "It happened. There it is. Get in." Put your money where your mouth is.
Sometimes we're so busy serving our existing clients that, like, I can't worry about somebody who didn't want our advice at a time when
I get that.
Could need it. And I'm trying to be kind about it, but you're right. Those people who are looking, we only want your help at a specific point in time, whereas we're committed to our existing clients. At those times, that's who is our clients are always going to be our priority, as I assume.
Sure, and I guess I don't mean it from a na type of standpoint.
No, me neither.
But I told you so. But I think if you're if you're thinking that in your head, if you're an investor and you're thinking, I should wait. I should, maybe the market's high. There's some uncertainty. All these like catchy buzzwords that you hear. Maybe I should hold off, play it by whatever. Like, it happened. You're great, like 40% decline where you're supposed to take the money out of your house and back the truck up, and all those other buzzwords that you didn't like. That happened 2 years ago. So if you didn't do it, why didn't you? And the reality is because in the moment, it's scary. I don't care. I mean, third one for me, I went through 2000, 2007, and then this one. I remember being on a walk with my wife, during COVID, and I'm like, golly, I just don't want to deal with this again. It's painful. Even if you know the outcome, it still sucks. It's still uncomfortable, but that doesn't mean that you have to make bad decisions with that, So if you're an investor and you're like, well, I think the market's high, I should wait. Take a look at your behavior when it was low. What did you do on March 23rd of 2000? Did you, in fact, max out your credit cards because you believe so strongly in the decline that now's the time to put the money in? Probably not.
Well, and I think that is the part of paying an advisor that people sometimes miss out over is we'll make some little nudges over time to avoid those mistakes. You said something that I say all the time. A lot of investment success is just avoiding mistakes. And if you avoid the big mistake, that usually can get you more than half the way there. The little mistakes, those little nudges along the way, though, are helpful. And I do think that when you go to see a doctor, you take their advice on the spot. When you need to hire an attorney, you typically take their advice on the spot. One of the things I think that helps me and I imagine helps you is the fact that we're out in the public expressing these opinions on an ongoing basis in a way that's easy for people to digest. But even still, some people just don't have the emotional makeup to deal with the things that are required for making good money decisions. And in that case, obviously I'm biased when I say this, but that is why you need to outsource. The moment that you think you are going to somehow trick the system and come out ahead, you've already lost. And I think that there's a lot of people out there that think that it's easy. And part of that's because the media makes it seem that way. It makes it seem as if it's possible, but it's just not.
Well, and the other part of that is what is that caused from? Like when you're trying to outsmart something, what is that the result of? In my opinion, it's the result of feeling as if you're behind because you haven't made good decisions up to this point. It's almost like a little bit of the, come to Jesus meeting, right? It's like, crap, I'm 47 and I should have been doing this for 25 years. Yeah, you should have, but you didn't. So you can't undo that. You can't unring the bell, but you can make good decisions moving forward. And I think that where we try to come down from Stacking Benjamins, where I personally try to come down and have for years, is that my goal when I talk to you is that you want to talk to me again, in like a week from now. You know what I mean? Like, I want to leave you with like hope and optimism. Like, that's my dude. Like, I want to hang out with him. He's fun. He knows what's up. And part of that is,
you don't want it to be like going to the dentist and getting a filling.
Which I do use a dentist analogy. Yeah. No offense to dentists out there, but maybe I should use a different one. But I think people feel, because of the culture, because of how under the radar all of this money talk is, people feel that, oh crap, I'm behind. I got to do this radical thing. I need to go on Wall Street bets and put all my money in GameStop because I saw some 19-year-old make $250,000 in an hour, and I need to do that to catch up. And now I'm going to do it, and I'm going to lose. But the reality is that if you're 47, if you're 52, we've helped, and you've seen lots of people who turn the ship around and are perfectly fine by retirement age. Now, is it a different process? Is it a lot different if you save $100 a month starting at 22 versus having to save $1,000 a month when you're 47? Of course it's different. It's a different thing. But that doesn't mean that it's undoable. And so if you find yourself in that spot, if you're like, all right, I just kind of came to grips with the fact that credit card debt's bad. I should probably focus on paying off my house. I should open up my 401k and get money invested. I'm starting. You don't have to feel like you're so far behind, because time is the great equalizer. If you're 40, you have plenty of time. If you're 50, you have plenty of time. If you're 60, you're running out of time, but I still think you have time, And so you don't have to go like, well, either A, all's lost, who gives a crap, I'm not going to do anything, nor do you have to do the other extreme, which is try to make up for lost time and do the bad thing by not following the right organization. There's a reason why the pyramids are built in the structure that they are. They'd probably be a lot cooler if they built the other way, but I don't think they would have lasted 3,000 years or whatever, right? You have to build it the right way. There's a big personality in our space, Dave Ramsey. You can agree or disagree with a lot of his stuff. I happen to think that the beginning parts of his baby steps are rock solid. The reason that you get into credit card debt is because you don't have cash. So you should probably have some cash. But cash is boring. It only pays 0.5. And I'm losing out. No, you're getting the opportunity to invest by having cash. If you have a cash reserve, you can put your money in stocks. If you don't have a cash reserve, you have to have your money conservative, because what if the water heater breaks? I mean, you got to look at the big picture. And to your point, sometimes you need professional help there. You're using the doctor example. I've had different doctor appointments, right? Sometimes the doctor's like, yeah, I think you should eat more salads. That's the little nudge, right? Like, and then there's the, yeah, this is a problem, right? We need to fix this right away. And so part of, I think, professional help, no matter where it is having that relationship with that person that can delineate between those things, right? Like, you'd feel a lot different if your doctor's like, you need to eat more salad. You're like, whoa, dude, chill. Okay, I will, versus, yeah, these numbers are terrible. You need to start taking this pill tomorrow. Like that hits home pretty quickly. So you got to have a good, there needs to be a good bedside manner, I think, there too, to steal another doctor analogy.
Well, Josh, this is great stuff as always. And there's a couple questions that I ask all my guests. And I think this first one actually bleeds in pretty well to the conversation we're having. I'd be curious if you could share, at as high or as low of a level as you're comfortable, how do you invest your own money?
Like a drunken sailor. You already knew the answer to this question.
Well, yes, I'm hoping you can tell the rest of the crowd.
Elaborate a little bit on it. I have said on the show many times that everything that you can do with money, I've done twice. The first time to figure out how silly of an idea it was, and the second time because I wasn't sure the first time was truthful. Have you been in credit card debt? Oh, yes, I have been. Twice. Up to my eyeballs. The first time it was terrible. I hated it. And then I was like, but I should try it again just to see. Yeah, it still sucks. It's really bad. Should I day trade penny stocks based on Reddit? Of course I should. Did I lose all my money? Absolutely. Should I try it again? Might as well. Maybe I'll get lucky. But I kind of ascribe to the philosophy that our good friend Paula Pant has. She has a great show called Afford Anything. And her philosophy is around budgeting, but I think this works toward money management as well. Rather than having a budget of like, here's how much I can spend on cable and going out to eat and so on and so forth, let me turn that on its head and say, well, what do I have to do to reach my financial goals? Okay, I need to put, money in my 401k. My spouse needs to put money in her 401k. I need to fill up my Roth. I need to get an HSA, Like, so I've got that stuff. And I know that as long as I do that and have that be on autopilot, so I invest my money in that the same way that we have our clients invest. We use a lot of low-cost passive investment products like Dimensional or Vanguard or whatever, the same stuff that you hear everybody talking about. So that's the stuff that we use. All stocks. I don't think that fixed income has a place in an investment portfolio, but that's another topic. So that's that money where I know that as long as I do that for the next 20 years, everything will be fine. I have a lot of equity in businesses that I own, which is completely illiquid. Any business owner or entrepreneur can appreciate that. I was filling out a balance sheet for my banker for something the other day, and I was like, "Good night, that's a big number." I feel pretty puff my chest out a little bit. That seems like a big number, and then it's like, but 20 grand of that's in cash, so so I can have a nice vacation with this gigantic number. It's so completely illiquid, looks nice on a balance sheet, but doesn't provide any cash flow. I've invested in rental properties. I'm actually on the way out of that. And this is another thing I think that's really important. When you have an investment, especially if something's not indefinite, like retirement, like I need to invest for retirement, that's kind of an indefinite goal. I bought these rental properties in Michigan a couple of years ago. And my idea was it's a 15-year loan. If I can break even for 15 years and at 3% inflation on the properties, they should double. Therefore, in 15 years from now, I should cash flow the mortgage payment and have a paid for asset that's worth double what I paid for it, actually 4x what I paid for it because I put 25% down. So in my mind, that was my goal. So I had an exit strategy going into it. Because of the housing market the way it is, being a little frothy, let's say, I met my goal in 2 years. So the properties were worth double what I paid for them inside of 2 years. And I was like, I won. Like that was what I wanted to do in 15. Now, sometimes you could look at that and say, well, what happens if you let it sit there for another 13? Would it not? Yeah, maybe. I don't know. But my goal was to double it. And I did. I'm out. So we're getting out of that space. Yeah. And then I have tons of American Express points. So I don't know if that counts for anything on the investment side, but oodles of those.
Wouldn't it be fun if you could invest points? I know you and I are big credit card junkies. If we could find a way to invest those points.
Fidelity allows you to get cash back, right? So
okay. Well, I want the points. Can I like drip reinvest my points so I earn more points on my points? But that sounds like something for the blockchain.
Oh, I see what you mean. Yeah. No, that's a good idea. I hear what you're saying. Like I've got 5 million membership reward points. Those points should be making membership reward interest.
Right. Instead, the credit card companies devalue them every few years. So spend them if you got them, people.
Yeah, they do.
Josh, one more quick question before I let you go on your way. What does being a long-term investor mean to you?
You did give me this question ahead of time, and I looked at it and went, "Yeah, I don't know," but I have an answer now. So I have this interest in how multi-generational money works. It's nothing that I've gotten in my life. My grandparents were on one side farmers and truck drivers. I learned a lot from that, but I didn't get any money out of it. I learned a lot about working on a farm and, whatever. And then my other grandfather was an entrepreneur. And what's interesting is I have a whole slew, I think 17 cousins, of which all of us are boys, except the last two, which were girls. One was my sister. And so my grandparents, kind of family trees, all boys. And only me and my cousin, one of my closest friends, are entrepreneurs. Everybody else isn't, even though our grandfather was. And so he lived a very long time, and also never had a ton of money, but always had enough. Grandma and grandpa always had the cool parties, like tenderloin and stuff for Christmas, which is cool. So I have this interest in longevity and in multi-generational kind of money. And I heard that story some years ago about the Vanderbilts. You probably know this better than me, but the TLDR version of this is, one of the richest people in the world, frankly, in the universe of all time, like in the late 1800s. By the time 100 years later, they had a reunion, not a single person in the family was a millionaire. And it's just kind of interesting. So I thought to myself, I have 3 kids, and I thought each one, hopefully my 3 kids will have 3 kids. That'll give me 9 grandchildren. And I thought that would be pretty cool. But then I thought, because I'm going to live to be 140, I'll know all these people. So those 9 grandchildren, Lord willing, will have 3 kids. That gives me 27 great-grandchildren. Okay. And I figured out that the earliest time, I can't help my kids. Their ship has sailed. My grandkids can't help them either. I need time on my side. And so the earliest my great-grandchildren will retire will be approximately 110 years from now. That gives the earliest ones age 60. So I've got 110 years. So I got some time on my hands. And I thought, what would be an amazing financial independence number? And in today's dollars, I decided that if I could provide $25,000 a month in today's dollars, a pretty profound amount of money. And I've got to do it for 27 people.
Sure.
And then I've got to do it times 110 years of inflation. So now, and into perpetuity. So I'll save you doing the math. The number's about 7.5 billion, roughly. But I got 110 years. So, there's a chance. So the question is how much money do I need to set aside today for my great-grandchildren to have $7.5 billion to split in 110 years from now?
Yeah, and I think, with the time.
What do you think the number is?
That's an incredible way to think about it.
This is the punchline, Peter.
I like the thought. Sorry, we keep speaking at the same time. I'm interrupting you.
I said, what do you think the number is? This is the punchline of the story.
Of how much you need at the start?
Yeah, how much do I have to put away today?
I will say 10 million.
Yeah, it's about 300,000, depending on
what
kind of numbers you use for growth rates. So, big number, right? 300K is not zero. I don't have an extra 300,000 today to earmark for this, so that's not happening. But I think in the context of, the answer to your question of what does it mean to be long term? It's impossible for our brains to recognize the power of compounding. We just can't do it. If you took a piece of paper, tell me if you know this already. If you take a piece of paper and fold it in half, the paper is now twice as thick, right? And you fold it in half again, now it's 4 times and half again. So there's some theory that you can only fold a piece of paper 7 times before it's, whatever.
That's correct.
So imagine if you could fold it 50 times. So every time getting twice as thick.
Yes.
Okay. Yeah. How thick is the piece of paper? How tall?
Now, the only reason I know this is because it was in my book, but it's from here to the sun.
Yes, it's from here to the sun.
I wonder if you learned this from me.
Maybe that's where I got it from. I got it from your book. Thank you for that, Peter. See, that was a good lead-in. But
it is still shocking nonetheless. I sort of stole your thunder there.
No, good. I was a tee-up. I teed it up for you to pitch your book again. Because I looked at the Amazon rankings. You definitely need another swath of sales.
I've fallen in the last few years. Yeah, so all the listeners, please go out and support the book.
So my point is that we can't figure out compounding in our brains. And wherever you stole that idea from, or is probably where I stole it from your book. And there's other examples like that about rice and different things like that. It's the whole penny compounded every day for 31 days is 5 million.
Yep.
It's just, that's what it's about in terms of being long-term is it's impossible for you to comprehend the fact that in a generation and a half from now, you could have $7 billion for your great-grandchildren. If my parents would have set aside $1,000 on the day that I was born, I'd be a multimillionaire today. And you go, well, why didn't you do that, Mom and Dad? And they go, because I didn't have $1,000. It was 1977, you dummy. And I get that, right? And so back to all of the stuff that we were talking about, I think there is more time than you think. You don't have to worry. You don't have to try to swing for the fences on every pitch. You don't have to go well, I can only, this S&P fund is boring. I need something with a little pizzazz to it. No, you don't. Just do it. for the next 100 years, and your great grandchildren will have billions of dollars. It's not that complicated, but we make it complicated because we try to find all the newest things and, and screw it up. So do the thing, do it very simply, take the guesswork out of it, and then, live to be 140, and you'll get to see all the results of this.
That's incredible. I love that response. Josh, thanks so much for doing this. If people are looking to find you, you mentioned your Twitter account. We've mentioned the show. Where should people be looking to find you?
So Stacking Benjamins, we are on all the podcast players, whatever your listener, wherever you listen to podcasts at Stacking Benjamins, stackingbenjamins.com. I am at Not the Fake OG. There's apparently the real OG. I am not the fake one. So I tried to purchase the real OG. The guy said no. So at Not the Fake OG is on Twitter, and just come along, listen to some shows. We have some fun doing it, and upcoming Peter Lazaroff. So
yes, by the time this episode plays, you can go to your favorite podcast player, look up Stacking Benjamins, and Joe, and you will be interviewing me there. So go ahead and check that out, everybody. And Josh, thanks again for doing this. If you all are watching us on YouTube, be sure to like and subscribe, and love to hear in the comments, what would you do for your great-grandchildren? If you're going to take the Josh Bannerman plan, which is very much like a Ben Franklin type plan for anybody who knows what he did with his
kind of like a Stacking Benjamins plan.
Period. That's right. Well played, sir.
See what I did there?
Do leave us a comment. I absolutely love it. Everybody, thanks again for listening. And until next time, to long-term investing.